Hello, everyone. Thank you for joining us and welcome to the Hart Investment Group 2026 Annual Outlook. Today, Ben will share his views for the new year, including insights on the markets, geopolitics, and the global economy. Before we get into it, just a few housekeeping points. If you have any questions or comments, feel free to them in the Q&A box up top. Either of us will catch it. Also, if you're not able to sit through the session or you want to go back to watch, it will be uploaded on our YouTube page at Hard Investment Group within a day or two. All right, let's get into it. Ben Hart, 2026 Annual Outlook. Over to you.
Just like that. Time to go.
Just like that.
All right. Excellent. Okay. Thanks, Eva. I'm just going to share my screen here and then let me know once you can see it. And
Hello, Ben. I think you froze up there for a bit. Okay, please bear with us, everyone. I think Ben is having a bit of network issues, but he should be right back in a couple of seconds. Thank you.
was that me and my teams crashed?
I think so.
All
Good to
right.
have you back.
Okay. Back here.
Okay.
As soon as I hit share, it decided that it would leave and go somewhere else. Let's see.
Technology.
That's it. Let me know if you're good to go whenever you're ready.
All good.
See it? Okay, excellent. Well, thanks everybody. Um, uh, Here we go. So we are recording this January 29th, 2026, around 12:33 right now. This time of year, I always think about what's happened, what's going on. I thought back to when I recorded my first annual outlook. For those of you who joined me for that one, that would have been in person. So that would have been 2015, I think was my first one. So I think this is the 11th year I've been doing these sorts of things. It really gives me time to think back and reflect about the past events, what's going on. 2015 was a choppy market, 2018 another one 2019, 2020, 2022. So there's been a number of periods since I started this. It gives me time to think about what to do, how to make the decisions. I reflect back on what I was thinking at that time. And I think it's important just to think about that the market is constantly changing. And as a result of this, this forces me and everyone to, I think about what's coming ahead. And our job as portfolio managers and investors for you is to try to see what's around the corner. And trying to see what around the corner involves a lot of time to think about portfolios and perspectives. And so, that's what I'm hoping to cover today. And thanks so much for joining me. And please enjoy the outlook and the presentation. But let's start. The opinions in here do not necessarily reflect those of National Bank Financial. Everybody's suitability and risk tolerance is unique and different. If you have any questions about anything we discuss in here today, please reach out to Eva or I, and happy to address and or discuss them and see if they are suitable for you. So lots to cover, so many different things. So what we're going to go through today is how did the markets finish last year? This is one of the things that people want to talk about, and probably one of the most important things, certainly, is where did you make money last year? The other key piece, there's been so much talk and discussion around the AI story, and I'm not going to cover a ton of AI story today, but I think it's still relevant and important. But just wanted some thought around how different asset classes can do in different periods of time. I read lots of the research out from the different investment houses, both in Canada and the US and internationally, just about how AI is crushing everybody, that technology stocks are the only place to be. So I thought it was relevant just to peel that back a little bit and think about who did better last year, Nvidia or the gold miners. And we'll show you a chart on the next couple of pages, and you can have your own opinion based on that. What did the economy do? And I have lots of conversations with people about the economy. And I think one of the things to think about here is the economy is not the markets, but they are connected. And you need to think about how they work together. And so, how did the economy do, and what do we expect ahead? What happened to jobs? I think this is really important as we've listened to the central banks over the past many meetings. This is one of the key priorities that's being discussed is what's happening to the jobs market. And so I think this will be a big driver for central bank direction in the next 12 months. So that'll be something to have a look at, and we can have a quick look at a chart on there. Inflation, I went for a decade without anybody ever talking about inflation until we came into COVID. And then that seems to be the front news headline every day is what's going on with inflation. So, we can argue about the metrics they use to gauge inflation, and you might not like them, but I'll tell you the coffee is up 100% since COVID. So I know there's inflation there, but the inflation metrics that we look at, core CPI and such, we can see where it's at today. Geopolitics could do a whole 3-hour presentation on geopolitics right now. So I have one slide on that. We can talk about that, but I don't plan to dig in too much. Yes, it's important. Yes, it's going to have an impact for markets and economies, but I don't think it's the only driving factor. And for those of you that I've had one-on-one conversations with over the last 6-8 weeks, certainly we've talked about that and can continue to. If you have questions, we can dig into it. Interest rates, major driver for what happens. Interest rates really drive outcomes, particularly in the consumer-based economy that the US has. Higher interest rates slow the economy, have a negative impact on stocks and such. Stock sectors, which countries did best last year? We're going to look at that. And then, of course, the now what? What's ahead? How do we position for what's ahead? Decision making, thinking around what's coming. And then the last piece, which I wanted to talk about, is the Hart Total Terrain portfolio. This is a global best ideas basket. So I've been running this for many years, but finally launched it October 1st last year with Eva's help, and we are rolling it out now. This is the best ideas that I've been running. It's a third Canada, a third US, and a third international. So we can talk a little bit about what that looks like and where it can fit. So let's start off with how did the markets do last year? And so this is an important screen to look at to see what are the major things to pay attention to. And I get lots of conversations around what's the one thing I should watch? What's the one thing I should watch? Well, the challenge with investing, unless you're investing in one area and one sector exclusively, is there's not one thing to watch, but I think there's many things to watch. But a couple of the key pieces that I think, if you're interested in what's going on in the economy, I think the two areas that are very relevant and on this page, anyways, is the 10-year bond in both Canada and the US. It's a reasonable gauge to give you an idea for what's happening in the economy. If the rates are where they are, this was December 31st numbers. So if you get interest rates on the 10-year bond going up, probably means the economy is expanding. Going down, it's contracting. Very simplistic, but just giving you a gauge to think about. Similar with the US, if the interest rates are going up, the economy is probably expanding. If interest rates are going down, there's some concern that the economy may contract. Yes, there's other influences, central banks buying, pushing, moving rates around, and we'll talk about that in a bit more detail. But just on a high level, what's going on with the economy perspective, those two places are important and relevant. TSX levels around 31,000, S&P 6,700, NASDAQ 22,000, and the Dow 47,000. A couple other key pieces to pay attention to is gold and silver. So we crested through something like 5,600 today on gold, just to give you a context of how quickly that moved. Silver went through 100 as well. So these are interesting things to pay attention to and think about. There is this fear, which I think is a little bit unfounded right now, but there is this fear that the US is completely undoing themselves from the global reserve for currency status. I do think it's coming, but I don't think it's imminent. And there's been that theory thinking around that those two are going to continue to go up as a result of that. There's tremendous amount of fundamental reasons why gold and silver could go up, but right now it's been trading off of momentum and speculation driving it higher. So I think those will be important to pay attention to this year as well. Um, Oil around the $60 mark is attractive from an entry into buying stocks at that level, because I think that we're likely to see a bit of a reversion higher in that case. But these are the things I'd say that are indices that I pay attention to on a daily basis. There's a number of other economic factors to think about, but I'd say look at these. 12 months from now, we'll update these numbers and we can have a look and see how things played out. So the next one is who did better? GDX versus NVIDIA. So yes, NVIDIA had another good year. So this is 12 months. So NVIDIA was just under 60% for the year. But to give you context, GDX, which is the gold miners index, so that would be Barrick and Newmont and the big gold producers like Nico Eagle. So it's the basket of gold producers, and you could buy it as an ETF. So GDX is the ETF. So GDX was up 120% last year. So just some context around what happened and what went up last year. We had lots of clients have exposure to precious metals. The majority of clients had exposure to precious metals either via the metal directly with gold, silver, or through some of the miners. And this was a big positive contributor to portfolio performance last year. So happy to see that. And now I'm on the other side of this is what do we do with it now? And we'll comment on that as we progress. So gold miners really outperformed NVIDIA last year and most of the AI stocks. So this is the economy. And so let's see what happened to the economy. And this is, I think, a reasonable report card just to think about what happens from here. What do we need to pay attention to? On the left-hand side of this chart, you'll see the United States economic forecast. On the right-hand side, you'll have the Canadian economic forecast. And then down below, interest rates, forecasts on bonds, currency. So this is, if you're looking at the economy from 10,000 feet, there's a great report card to think about. What I'd look at from this perspective and where some of the, I'd say, fear is around what's happening with US dollar is the current account deficit. So, 2025 current account deficit was 1.3 trillion. I think we're talking a trillion plus deficit, current account deficit for the foreseeable future in the US. So that's a number I'd pay attention to. Right now, it's forecasting that it's going to come down, but I wouldn't necessarily think that that's the case. On the Canadian side of things, similar. We're showing 50 to 60 billion dollars of current account deficits for the foreseeable future. Again, Carney's into the early days still of his leadership, and I think that'll be important to watch and pay attention to. But I think the ratio of these, how these play off against each other, plus the differential in interest rates, will have an impact with the Canadian US dollar. I think that'll be important to consider. Stripping away the geopolitical risk with Trump and Carney and what's going to happen that way, this is just a pure numbers economic view. So if we look down here into the center, we got the Fed funds target rate. So that's the FOMC. So that's Powell. He controls, with his help of his team, controls what happens to interest rates in the US. And so right now we're at 3.5% overnight. Our economics team is forecasting one more cut, 25 basis point cut this year. I personally think that that's probably light. We'll look at a few things in the next pages which will support that, but we are going to have a change of leadership in May of this year, where we have a new head of the FOMC that'll come in, and I don't know who it is going to be yet, but I can tell you for certain it's going to be someone that's going to be pro stimulating the economy. And what does that mean? that means that probably they cut rates faster than expected. And so my view is that rates come down more than is currently being forecasted. There's lots of runway to come between now and the end of the year, and lots of runway even now between May when Powell is out. So I do think rates actually soften more than is currently priced in. Additionally, one of the things that the US needs is they need the consumer to feel healthy and happy. And in the US, the mortgage market is based off the long end. And so right now you're looking at 4.75 for 30-year bonds. And so mortgages in the US are priced off of that. So you're looking at roughly 4.75 plus 2% or so, where long mortgages in the US right now are around 7%. And as you approach that 7% number, that's quite punitive for the US consumer, and that puts a lot of pressure on them. So I'd anticipate that we see a flattening of the yield curve, and that is really not priced in right now. That market is quite cheap and something that I think will be important to consider how and where that fits into portfolios at this point. And then if we zip just over to the Canadian side of things, so we're at 2.25% on overnight rates. And our view is that there are no cuts or increases until Q4. And our economics team is forecasting rates go up in Q4. I don't necessarily line up with that view presently, just based on how the economy is going right now in Canada. But I think we got lots of ground to cover between now and the forward guidance. If you look at the December overnight rate forecast, like the rates market right now is actually pricing in about 10 basis points higher, so like 2.35. So I tend to line up more with that, given where we are today versus where we're going. Lots of ground to cover. That can have a big change, and interest rate forecasts changed dramatically last year, and I'd expect them to continue to do so this year. The Canadian housing market, though, is much more dependent on overnight and the 2 and 5 year rate. So right now, we're not forecasting much there happening. A couple of basis points on either side. So pretty benign changes in interest rates. And a lot of this is going to be contingent on how the economy does, what happens to the job market and such. But I think this is a great chart just to have a look at where we see things and where we think things are going. So part of why my view is that accommodative policy from central bank becomes better, which is cutting rates effectively, is that we're starting to see this happen. This is U.S. unemployment has risen to a 50-month high, and so you may see headline numbers that don't necessarily line up with that, but we're seeing an uptick in unemployment in the U.S., and so that is based on a number of factors. And right now, we're seeing some positive things where Trump has lowered corporate tax rates, and that should be a stimulative to the jobs market in the U.S. if the corporations are coming back to the U.S. and so on and so forth. But this number and this metric, I think, is going to be very important. If we look back across this chart, these dark brown areas are recessions. So obviously, we saw around 1991 we had a recession. 2001 we had a recession, and then in the housing crisis 2008 2009, a pretty material recession, and then a brief blip of a recession of COVID in 2020. So I think there's a near-term feeling that recessions don't happen anymore. So we're going to see, but unemployment is rising, and I think that's an important number that we need to pay attention to. Okay, so we jump on to inflation. As I mentioned off the top, there is lots of thinking about what's happening with inflation. And I mentioned lots of conversations I have with people is around, how do they get to that inflation number? Everything's going up, what I consume is going up, and so on and so forth. Again, we could debate that all day, but it doesn't really matter because these are the metrics that the central banks plan off of. And so we're seeing US inflation surprised to the downside. Canada was the same as well, inflation surprising to the downside. And so I think part of my thinking around where the Canada and US central bank, they have some room now, is that they have the ability to look at these inflation numbers and they keep coming down towards their target. And inflation's never been at target. It's either above it or below it. There's not something that stays exactly at 2%. It gives the central banks the ability to cut rates. And yes, if they cut rates and stimulate the economy, expand their balance sheet, that's going to potentially cause inflation. It's certainly going to cause asset price inflation. Is it going to cause inflation in everything else that we eat and consume? I'd say probably not. But this is an important thing to think about where we are right now because there is a bit of fear in the world, and inflation coming down. Interest rates have gone down a couple of times, but now have stopped in the US. I still have the view that interest rates continue to head lower in the US. And if there's any surprises to the downside from an economic perspective, we could probably see a bigger move to the downside in inflation. Geopolitics. And so this is my one slide that I wanted to put up about geopolitics because I think this started the current situation that we're in the world. And so as for those of you that watched the anything to do with news around the tariff tantrums, which would have been early last year. It's hard to believe it is last year considering what's transpired since then and how much ground we've covered. But President Trump put these Bristol boards, these billboards up around how he was going to tariff all of these countries because of them taking advantage of the United States. And so I think this is the start of what has led to where we are today, which is the conflict that, let's say, the rest of the world is having versus the US. All of these numbers have changed since these came out, but I think it's been the big driver of what happens. There could be some Supreme Court changes that tend to throw this straight to the trash. But I think this is what has precipitated a lot of the geopolitical risk that we have right now. We've seen Venezuela, which I think there's still more to come there. We've seen President Trump talk about Greenland and Cuba, and the Ukraine-Russia conflict continues. Iran, Israel, Qatar, Saudi. There's so many geopolitical things going on right now. I'm not going to dig into all of them. I certainly pay attention to them, follow them because they have an impact on what's going to happen to your investment portfolio, but didn't want to spend the whole time talking about geopolitics. And I think this is the chart that really set things off to what happened to the world and where they decided to, the US at least decided to take a different tact and be a little bit more aggressive with the rest of the countries that they trade with. So Canadian yield curve and US yield curve. So if we look at these two lines on the left-hand side is Canada. So the blue line is the where we were a year ago, which was quite a flat curve to where we are today, which is a steepening, which is a natural curve. So I think the question is what happens from here? My view continues to believe that I do think we see a flattening again in both Canada and the US, but that's a year ago versus where we are today. So not too much change in the mid range around the 10-year mark, but front end quite a material adjustment. And then the US yield curve. So this was a year ago, which was the blue line. Again, quite flat, and now the red line is where we are today. So you're looking at the 2 years a little bit lower than the 3 year right now, which is interesting. And so I do think that we see a flattening on the long end, but right now essentially unchanged from where we were 12 months ago. Now, if we look at markets and get a little bit more discussion around what happened in markets and investments last year. So, Charlie, who puts out this research, is always excellent. I love this from the view that these are all the countries, and then the ticker symbol, these are the ETFs that actually are investable assets. And so this is a good comparison around what's working, what's not. And I always like to look at, which economies did well, which ones didn't, and then try to understand and reference what does this mean from a market perspective. And so we look up at the left-hand side, of course, here we see South Korea. South Korea had a great year from a market perspective. And then we look down on the right-hand side and we see Saudi and Turkey. Turkey's not an investable asset for me, but Saudi, I look at it and go, okay, what happened there? Interesting because the country is very heavily leveraged to energy and finance. So that might be something to explore and think about. Maybe there's an opportunity set there as well. I look down here, we have India and Australia. I mean, India, the fastest growing global economy right now, in my view, is at least for the foreseeable future. You got Modi that's trying to make some changes. India is probably part of some type of future reserve basket. So their markets didn't do super well last year, and which presents, I think, an investment opportunity. So this is where I'd be looking to kind of sift through and seeing what worked, what didn't. And then, of course, the US actually underperformed the rest of the world from a total world perspective last year. And so that also is interesting. It's okay, where this big fear keeps the bubbling up about saying AI is overdone, AI is overdone. Well, the market actually didn't do exceptional last year relative to the rest of the world. And so I think that would be something to think about. Is there a reversion to a mean? Is there, an opportunity there? Which companies didn't do well versus others? So I think it's important to just not toss out the fact that the U.S. has the only AI story right now. There's some good companies there that are worth considering as well. Now we look ahead for what's coming. And so let's start with the framework, which is the World Economic Outlook. And so this is put out by our economics team. And so one of the things that I think I spent far too much time early in my career under thinking about absolute numbers as opposed to the rate of change of those numbers. So I learned a lot from Keith McCullough at Hedgeye, just thinking about the rate of change of numbers are more relevant than the absolute numbers. If we go from -4 GDP to -2 GDP, we actually get accelerating GDP. That's really positive catalyst for equities in that backdrop. So I think it's important to think about the rate of change as opposed to the absolute numbers from what that's going to potentially mean for the economy. And also, you need to think about how the economies have done recently and loop it up back to the previous slide, which I showed you, which is what happened to the economy, what happened to the markets, and are they fully priced in based on how those two things connect. And so when I look at this chart here and look at the US, we actually think the US economy expands over the next 12 months. So that's a bit interesting because we had a fairly modest return from US markets last year, and we think the economy is going to expand. So those two things are interesting to be conscious of. Eurozone seems to be positive. Japanese market had quite a good year as the yen depreciated. My view is that's fully priced in. I actually think we get a counter trade there where you get some kind of yen strength and economic weakness. There's been a lot of manipulation in the bond market in Japan, as most of you probably know, and so Japanese yields have risen. I think there's going to be a catalyst for the Japanese government to intervene and go back to either some form of yield curve control, which is pushing rates down. So I'd be on the other side of that. I think that's fully priced into the Nikkei at this point. Canadian market shows a deceleration. Okay, that's unique. I think the Canadian market outperformed, very heavily weighted to precious metals and some in financials as well. Australia, we're seeing an acceleration, and their economy and their markets didn't do super well, so that's interesting. If we're seeing acceleration, maybe the it's not fully priced in there, so we should think about that. Now, if we look down to the faster growing economies, which are emerging economies, would be looking at India here. As I mentioned, the market went sideways to down. We're seeing economic activity actually decelerate a little bit, which probably means most of that's priced into the markets there. And we see India probably staying on this path, potentially re-accelerating if Modi is successful at putting in some of the policies and trading agreements in place like we've seen so far this year. So I'd say that's a slight positive, and that'd be an area of investment that I think is pretty interesting for the next 12 months. Russia is accelerating, but that's not an investable asset. Yes, very relevant to geopolitics and impacts and those things, but from an investment perspective, not in the conversation at all. So there's investment indicators that I think about on a continual basis. And this is from our Chief Investment Office team, and they talk about some of the things to think about. So in this area, the cyclical conditions, monetary conditions, momentum, valuations, and sentiment. So cyclical conditions, these are what's happening in the economy, both in the US, globally, and financial markets. So presently, right now, the US economy right now, which is jobs, manufacturing, housing, and consumers, this is in we'll say a risk-off mode or a negative kind of overhang in the markets right now. So that's why I think jobs is an important thing to pay attention to, and the central bank's going to care a lot about this. housing and the consumer, these two things are heavily linked. And so that's part of my view around where Trump has talked about, we need better rates as he's, talked about coming out with potentially trying to put a cap on credit card interest rates. And I think we'll see the long end of the curve move down because if you have a strong housing market, you have a strong consumer, and you have a strong US economy. So this is an important piece, I think, to pay attention to from where we go from here. Global economy is growth, breadth, manufacturing, economic surprises, and LEIs is leading economic indicators. So these are pretty positive right now. So I think we watch that. So manufacturing be PMI. So we watch those numbers. We see some economic surprises. Are they good or bad? Right now, fairly positive. And then into financial markets, which is equities, bonds, FX, and commodities. Again, still pretty positive there. So those areas we continue to watch. And then monetary conditions. And so, if we've looked and follow this quite closely, one of the things for those of you that have been joining me for many, many years, I talk about money supply, which is, we'll say, global M2, all of the money in the world. And so as we see money supply go up or down, it actually has a pretty material impact into asset prices, particularly equity markets. And so last year, we started to see M2 start to accelerate. And then we had the government shutdown in the US, which kind of muddied some of that data and information. And then we saw M2 kind of go sideways. And so right now it's been positive, but I'd be watching that quite closely. If we do see money supply start to tick up again, I'd say that's a positive for risk assets in that backdrop. And that'd be something I'd be conscious of and pay attention to. Within the other part, within monetary conditions, is policy rates, yield curve, credit spreads. And so right now we're in a slight negative on that side of things. So credit spreads are quite tight. The yield curve isn't positive right now in short-term rates. Again, still a little bit negative, and that'll be a piece that I think we'll need to watch and pay attention to, which could be a catalyst for prices going higher at this point. Momentum, which is relative and absolute, what's going on. Momentum's been quite positive up until today, actually. Looks like we're seeing potentially a bit of a rollover in certain asset classes, and we'll talk about that as I move through. Valuations, watch for extreme valuation spread between stocks and bonds. So we're at an interesting crossroads, I believe, right now, where we've seen bonds yields move up quite materially, 22, 23, and then been relatively sideways since then. And so when you look at bonds as an investment, there's a number of things to think about. Obviously, do you want to own corporate bonds or government bonds? But bonds, for the first time that I can remember, actually offer a reasonable value where you can get a 4 or 5% in bond land. That gives you some security and safety. And if inflation's not running away, that's a reasonable place to have some of the money. And at the same time, you got equity markets that are looking a bit stretched. Maybe their rebalance makes a bit of sense, but for this time, like in 2022, bonds didn't help. This time, I think bonds are actually going to be a decent amount of protection within portfolios. And from the valuations perspective, it shows you that right now. And sentiment. Sentiment is by far one of my favorite gauges, and I followed this quite closely. So this is investor optimism versus pessimism. We can look at this on a daily basis if you'd like, but perfection in investing is buying when there's extreme pessimism and selling when there's extreme optimism. Most of the year you filter somewhere in the middle near the top of that gauge. And so that's a little bit more difficult from a incremental investment perspective. But when we came into April of last year, when markets were down hard, and I talked to most of you, talked to all clients, in fact, in April of last year, I said, we're in extreme pessimism mode right now. This is the time for you. If you have money to add to your portfolio, take some tactical thinking and make some investments from the perspective of, people are scared. That's the best time to look for opportunities in the market. And then we saw that valuations start to move back up. And so we're sitting in a slight neutral right now. And so that's okay. And so that gives me some optimism around buying into a slightly negative sentiment. And then if sentiment gets worse from here, gives you more conviction around adding more aggressively. And if we get to the other side of that, which is extreme optimism, which is where gold, precious metals, and the companies in that space are right now, are extreme optimism, that's a sell signal for sure. So I put this chart up, I think, in one of the dailies, or we've talked about certainly in some of the weeklies, is, I love these charts that are connected. And so I've said this for years that alligators always close. And so when you get charts where two asset classes are connected, and the ratio now between gold and oil is at extreme levels, probably the most extreme. And so the view is, yes, does gold continue higher and does oil continue sideways to down? I mean, the answer is probably no in both cases. So I understand the fundamental case for why gold continues higher, but the technical setup right now is extremely risky. As for oil, oil's been in this downward to sideways trend, and that's a bit of a fear of what's happening in the underlying economy right now. And so, if we see some slight positive news come out, or the global economy is resting, maybe the U.S. decides they come to an agreement with Greenland and Venezuela. Maybe there's some positive indicators that rates are coming down a little bit more. You could see this ratio close quite quickly because that's a probably a risk off event for gold and a risk on event for oil. So I think the setup is interesting and something that I would think we need to pay attention to. I do think that both happens. We do get a correction in gold and we get an acceleration in energy, but I think this is a great chart just to signify how vast a spread that we're seeing in this space right now. And the other piece to pay attention to is the Canadian market, as I said, did quite well last year. A lot of it had to do with the commodity sector, precious metals specifically. And if we look at this chart, so this is gold stocks hit record weight. So this is the weight within the TSX. And so for those of you that own precious metals into 2010, 11, like this was the last time we reached this peak level where it's 12% roughly of the TSX. And then we've gone through this trough, which many, if you had invested in the space, understand what that means. And now we've got back up to the peak here. These tend to be extreme levels that we need to be conscious of. Yes, could something have changed? Yes, the fundamental reasons for it to continue to go higher there still, of course, but these are warning signals that I think we need to be conscious of when we're making our investment choices. The speculative positioning on the US 10-year, so 10-year bond. So this is 10-year bonds in the US versus the positioning on the Z-score here. This really shows you that the bond market continues to be sold out on the 10-year range. So speculators are still betting that yields are going to go up from here. I'm certainly not in that camp. Of course, it could happen if we see some kind of change and some kind of future destruction of yields in the US. Right now, there's this thinking that the US government won't be able to issue debt, and they have to do a tremendous amount this year, something like 8 to 10 trillion dollars in debt this year. Right now, though, the foreign buyers are, we'll say, 1 to 2 trillion a year, and the rest of that debt gets bought by some type of government entity, primarily the U.S. central bank, similar to what Japan's done and most other developed countries, and Canada does as well. And so, if they issue bonds, there's always a buyer. And so, at least for now, things can change by any means. But right now, this is something that I say is probably a decent place to have some money, at least if you're looking to add some protection into the portfolio. So I've put this up many times, and I just think it's relevant from a perspective of investing opportunities. And so there's lots of ways to be invested. Lots of time and attention goes towards stock selection. What do I want to own in the stock market? Where, what companies, what sectors? All of those are important. Spend lots of time on that. But I think in the bond world, because it's so extremely misunderstood, that I think oftentimes this is where some opportunities and some value add that I can do into portfolios by taking a small piece of the portfolio and getting you some exposure to an area that you wouldn't get just buying, we'll say something on the TSX. I think the one area that's the most extreme, and I'll point to two on this chart, but this is the US 30-year Treasury bond. And so right now it's around 4.8%. And so what could potentially happen in this chart is it could go up to 5.8% or it could go down to 3.8%, hypothetically. As I mentioned earlier, my view is that there's probably a flattening of the curve. So my present view is that rates come down. If you had a move from 4.8 to 3.8%, you'd actually get a 21% capital appreciation in the bond portion of the portfolio if you own 30-year bonds. So part of why I think this is important to think about is in all cases here, the risk rewards are quite attractive. If you look at the Canadian bond universe, similar. If we look at where we are today in the Canadian bond universe, you had 3.5% yields. So hypothetically, we go up to 4.5%, you'd lose about 3.7. But if we went down to 2.5, which is certainly possible based on my views, that's a 10% capital appreciation. So the risk reward in all of these cases right now are pretty attractive. And I think it makes sense to have some exposure there. And it's an area that people don't like to talk about. It's not super exciting, but it's an area that adds a diversifier in the portfolio, a true diversifier, not owning this stock over that stock. And I think it's very important when you think about portfolio construction right now. Uh, so a few more charts before we talk into the forecast around what I'm looking at and what I think happening ahead. And so these were three charts that I think are excellent to look at, which is WTI crude, WTI oil, excuse me. We've been in this downtrend. Now we're starting to show some life. We're starting to peak back up again. Gold's been in a huge uptrend, and I guess if you're looking at what does this mean, it's a couple of standard deviations above its long-term average. So from a technical perspective, I think there's some risk there. Copper, I understand the fundamental arguments for copper. I think copper can go higher and will go higher longer term, but we've seen a bit of a separation from historical norms, and so we're maybe looking a little bit stretched onto the upside here. And then if we look at the actual return numbers for silver, gold, and copper, I mean, silver was up 196% over 1 year. It's actually a little bit more now. This is January 16th data. So just to give you a sense that we've had a huge move, can it go higher? Of course, my personal view is you take profits into an environment like that. And where I'd be looking of trying to position for what's ahead, I'd look down here and say, okay, energy's down over 12 months across all spectrums, so natural gas, WTI, and Brent. And then if you look down below, actually agriculture is down 9% over 12 months as well. Are there some areas that we can look to reallocate some money into spaces that haven't done as well? This I thought was an interesting, great chart just around world government spending. And so this is the 2019 data, which is the blue, black, and then the 2025, which is the red. And so governments are structurally spending money. And so this is something that we know. And so this obviously contradicts my comments around gold and silver, is there's so much money and time and attention going to those assets because they're worried about the financial destruction of fiat currency. And so this is a counter argument and something I think we need to think about when we're thinking big picture. But looking at this numbers and then looking what's happened with gold, I think it's important to say, governments are going to keep spending because they want to stimulate the economy. I don't see any austerity in the future. It's possible, but with the present leadership that we see around the world, I don't see that as being a viable likelihood. And so I think it's important to have assets and be diversified and buy investments. But I thought this chart really stood out around how much governments are spending. Market construction. So this was a picture of what happened in the tariff tantrum last year. And so as we came into February, we saw the market drop 21% from February 19th to April 7th. And so this was a dramatic event. But I think one of the more important things to think about is these events happen on a continual basis in the markets. If you've been invested for any period of time, you'll understand that markets do correct. And what you do prior and what you do post is whether you're going to be successful at making money longer term. And so this was a steep sell-off, which presented tremendous opportunities. And I was fortunate to be able to take advantage of that and invest and make sure the portfolios did quite well and bounce back quite quickly coming out of that as a result of taking advantage of a market correction. And I think it's one of the things that we've been successful at doing for many years. Um, when I think back into 2020, in February of 2020, I bought S&P puts coming into the COVID event, and we see a material correction. Those puts were worth lots more. We were able to sell, capitalize, and add back into investments. So this is a snapshot on the S&P 500 index, number of all-time highs between 1929 and 2025. I came into the business, it looks like at probably the worst time. I came in 2000, and we had a couple of all-time highs, followed by close to a decade of no new highs. And so we entered this period here where the US significantly underperformed the rest of the world from 2000 to, we'll say, 2013. Then we've had the US take off, and it's been outperforming the rest of the world up until recently. And so I think it is important to think about this. Do we continue to see US outperformance or do we not? Are there new all-time highs ahead? The answer is I think there is, but I think we need to be conscious that there are other places we can be diversified, have money in different jurisdictions and different assets. And I think it's important just to remember there have been extended period of time where the US doesn't hit all new all-time highs, and that's where stock selection matters more. And I think we're starting to enter that period here. Talk a little bit about global central banks and just about what's happening and where we're going. This is a great chart. This is Switzerland to Turkey, so this would be all the major central banks. It just shows you around the different areas and what's happening. All of these green ones here are cuts. Their last ones were cuts. The handful of ones that were hikes were Brazil, Taiwan, and Japan. So we saw hikes in those areas. Taiwan's was actually March of 2024, so that's a long time ago. So it wouldn't necessarily be relevant for where we are today. But Japan and Brazil were more recent there in the last 12 months. But generally speaking, we've seen cuts across the board and then a number of holds since then. So what these central banks do from here, I think, are going to be important for what happens to the markets and economies. Excuse me. So the central banks play a major role for money supply, as I've mentioned. And so this is a snapshot of the US Federal Reserve. So that's the US Central Bank. They reached a high at one point of something in the neighborhood of $9 trillion in reserve assets. So they'd gone out and bought mortgage bonds and government bonds and effectively built up their balance sheet really to help the government and so on. And they've been doing quantitative tightening up until last year, December 1st of last year, I believe. And so their balance sheet went from 9 trillion down to 6.55. So this number, I don't think ever gets to zero unless we see a global jet jubilee, which is possible but not likely in the near term. So what has historically happened is the central banks have expanded their balance sheets into difficult economic conditions and then shrunk their balance sheets as the economy started to do better. They let assets roll off, they sold assets, so on and so forth. And so now that they've reached this level again, I think they've put themselves in a position to be able to expand it. And likely with the new Fed chair in place, you'd see some expansion to their balance sheet. So they've shrunk the balance sheet by 2.5 trillion. I'd say the next time they need to expand it, they'll probably expand it by more. So this is an ebb and flow that plays a part for what happens to investments and also what happens to your currency. So Canada, the recent easing has not affected 5-year rates. So the policy rate, which is the central bank's rate, this black line here, and then the red line is the 5-year rate. So policy rates are here, and the 5-year has still gone up in that backdrop. So I think that's a mispricing right now in 5 years. Historically, at least from what our economics team tells us, is when the central bank stops raising for the next 12 to 18 months, that 5-year actually comes down 80 to 90 basis points. So I think this is a bit of a mispricing right now in the market. And when we see a divergence that here, this type of thing, it makes me pay attention. What does this mean for an investment? And what does this mean for if we're wrong and the 5-year is correct? Couple more slides before, if there's any questions, certainly take them. But our economic forecast from our team, this is an outlook for where we are in Q2 of 2026. On the left-hand side is the TSX. So as of December, we were 31. Presently, right now, we're looking at 32.9, and they're forecasting Q2 to be at 31,150. So below levels where we're at right now. The forecast for Q2 of this year. So again, similar S&P 6920 right now. Their target is lower on the S&P, and this is purely based on fundamentals, but interesting to see where their forecasts are. I think it's important just to think of some of the risks and opportunities. So this is a chart just on quantum computing and just thinking ahead. And I'm always trying to think about where the future investments and where we could look to make outsized returns from. And there's been a lot of talk within the investment space just around quantum computing, AI, these types of things. This is a great chart from ARC's research. ARC, Kathy Wood does some excellent research just around forward thinking. And so I read over the last 12 months lots of research saying that we're close to quantum computing. This is coming soon. Based on what's out there, the power supply, the resources, the technology certainly could change that. But really, this research tends to indicate that we're quite a ways away from this. I think quantum computing can change many things, but I don't think it's going to be right around the corner. And it's something that could be a good investment thesis, but it's early days of it and still lots to think about where and how that could fit into portfolios. So two more. So the Hart Total Terrain portfolio. So as I mentioned, this is something I've been running for years, but really rolled it out as a basket with Eva's help. And so this is a third Canada, a third US, and a third international. So the top 10 holdings right here. So LVMH, Barrick, Intel, China, Internet, Mercedes. So Barrick I've sold out of already this year. Intel, we've sold half the position, added Advantage Energy and Whitecap into the portfolio as well. So this is a constantly adjusting and changing. Off to a good start since October 1st, up about 6% from there. But we'll be releasing more information. Eva's done up a quarterly to send out to you just to give you an idea of what it looks like. This will get implemented into portfolios. But if you have any questions at any point, certainly feel free. One-offs, we could talk about how and where this fits in more detail. Excited about having it into the mix. So I mentioned, thanks very much for joining me today. We've covered lots of things. Hopefully, I give you a bit of a snapshot in all of these areas that are relevant for what happened and where we're going. I'll finish up with the views of where I think some opportunities can be realized this year and are made over the next 12 months. And so my view, as I've said to you always, is to look around the corner. It's one of the most difficult parts of our jobs, but one of the most important as well, is to make you investment returns consistently without too much risk. And so as I look ahead, one of the things that I think could be a surprise here is the long end could flatten, particularly in the US. And so what would this mean? This would mean potentially huge upside for the long-term bonds as it's very underpriced. The market's shorted right now. There are so many things lining up to why this wouldn't work that there's an investment opportunity that I think could add some protection into the portfolio. As I mentioned in the earlier slide, the yen reversal, I think that's certainly possible as well. They have lots of political risks there. I think having some exposure there makes some sense. It's an area that's really not loved right now, and I think the Nikkei's had quite a good run, and maybe it continues. But if you see yields coming down in Japan, they've been forever in this yield curve environment until current political leadership took in. So I think the yen plays a major role in the financial picture, and that'll be something key to watch. Gold, silver reach maximum fear levels. I think there is this overarching fear that there's a fundamental change to the US dollar. And I think that's true. I think it's very true long term. I just don't think it's an immediate risk that the U.S. loses its reserve currency status. I don't think there's a system put in place yet to be a replacement for that. But right now, gold and silver are trading like that is happening imminently, and so I think it's a little bit overdone. And maybe we reach some peak fear, and that presents opportunities to sell and take profits, which we have been doing in portfolios right now. And if you get some good news, some good economic news, some softening geopolitical concerns that are happening, these could be quite positive for other investments, equities, um, technology bonds, which could balance the playing field. I think it's a real risk here. International markets, as I mentioned, as we went through the slides there, India has underperformed, so I think that's a great opportunity looking to implement that into portfolios. Saudi Arabia as well, because my view is that energy has underperformed. I think has some positive tailwinds from here, so Saudi's an interesting investment. Global dividend stocks. I think there's lots of companies out there in the world right now that present investment opportunities, not necessarily huge, exciting growers like Nvidia and or precious metals, but some global dividend stocks, good, consistent, that have been kicked out to the trash that offer good investment opportunities. Final two is consumer discretionary. So many beaten up names here. Nike, Under Armour, some of these companies have really been kicked to the curb. If we get some positive no news and tailwinds for the US consumer, I think you could see that pick up quite materially. And that energy, I didn't talk too much about energy today, but it seems to be getting a lot of time and attention and space, whether it's alternative energy, whether it's straight energy, oil and gas, whether it's wind power, solar power. There's so much energy that's going to be needed as we move towards more and more AI, more and more quantum computing, more and more power. I think this is going to be one of the areas that's the most underpriced over the next 12 months. So I'd be looking to implement and roll that out into portfolios. So thank you so much for joining me today. These are the levels that we talked off the top. I really appreciate the trust that you put in Eva and I to make good investment decisions to help you get to your goals. And we work hard every day to make sure that you're well positioned for that. And hopefully, I was able to give you a summary and understanding for what we see happening, what we saw happening, and what we see going ahead. We look forward to continuing to deliver on your goals and objectives, and look forward to another 12 months of interesting markets and interesting times. Eva, was there any questions that popped up in the queue?
No questions, but this typically means you were well understood.
Okay.
If you have any questions post-session, please email Ben or I, and we'll be happy to assist. We're wrapping things up. Please visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video when it's posted. If you'd like to subscribe and receive the newsletters, please send me an email as well. Thank you once again, everyone, for listening, and enjoy the rest of your day. Bye.
Thanks, everybody. Take care.